Good evening, everybody. Hopefully there will be some questions while I'm going through this. And if there are questions, again, for Brett or for Rob, please make sure you include those. So I'm going to give you an update on kind of the global crop markets. I'm going to start with a little bit of a recap of what's happening domestically here for each of the major crops, corn, soybeans, and wheat, and then jump fairly quickly into what's happening globally and how we might fit into the global supply chain. Before I dive in too deeply into that, I do want to, Brett touched on it a little bit earlier, I do want to give a brief update on kind of how we're sitting now with the railroad union contract talks. I tried to get information as of today. I know this is a hot topic. I've been getting a lot of questions and phone calls and emails about it. What are the implications? So I want to give you some context. Nobody knows exactly how this is going to play out, but I want to give you some information to put this in context for you. So the Union Pacific, Burlington Northern Santa Fe, as well as Norfolk Southern, are still negotiating with 3 unions on contract renegotiations. They represent about 60,000 workers. There's a deadline of 1 minute past midnight on Friday. So 1 minute past midnight on Friday, there was basically a presidential ordered cooling off period, and that cooling off period is going to end. As of right now, there were 3 unions earlier out of 12 that had not completed the negotiation process, where the unions had not approved the proposals. We learned today that one of those unions, representing machinists, mechanics, and maintenance personnel, if you could get a water, please. This always happens, right? Thanks, Brett. Apologize for that. One more time. So there was one union today that did reject their proposal. There are 2 unions yet to have completed their voting process. Now again, recognizing that this negotiation for most of these unions have been going on for almost 2 years. So we're getting down to the deadline right now. There are 2 unions that have not. Again, we don't have information on whether they passed or declined the contract negotiations. There was some information out this morning. Norfolk Southern said that it did plan to halt unit train shipments of bulk commodities on Thursday, which is tomorrow. They also announced that they were going to stop accepting any kind of automobile transit beginning today. So here's the point. I just want to remind everybody that we think in agriculture about grain and grain movements. When we talk about rail and rail movements and what happens within the rail system nationally, we're talking about a very large, broad base of products and commodities. So the Biden administration is working on a contingency plan. This has been obviously a hot topic now going on for a while. The plan right now, and we don't have any of the details obviously, is to focus on those critical goods if a shutdown were to occur. Now we don't know what definition of critical goods would be, whether agricultural products would be in that mix or not. So there's really 3 possible outcomes as we get closer and closer to this deadline. First, and hopefully if it doesn't pass, the parties will continue to negotiate without any kind of a strike or lockout. They will continue to provide service. Things will go on and the negotiations will continue. What it looks like today, that probability of that might be pretty low. The other possibility is that the union strikes or the railroads lock out the workers and there's either a stoppage or some kind of slowdown. The final is that Congress intervenes and extend the talks or to establish some kind of an agreement. So Congress can come in and actually order the 2 parties to continue to negotiate, or they can come in with a proposed solution to the problem and force the 2 parties to be able to accept that kind of an agreement. Again, a lot of unknowns. There'll be a lot more information coming out as we move forward in time, but I thought I'd give you a very brief update on what's happening. So let me start. I'm going to go corn, soybeans, and wheat. I want to touch on a few things. I want to kind of have the same cycle of information as we move through. I'm not going to spend a lot of time on the USDA forecasts, but I do want to use that kind of as a backstop or a backdrop for some of the comments that I will be making. So in the column on the far right-hand side, highlighted in blue, that's the information we got earlier this week. Again, as Brett noted, there were some small adjustments on the production side, a drop in planted and harvested acres, as well as a reduction in yield. And because of these reductions in production, there was some adjustments then on the usage side, or the forecast for usage as well. The one that got a lot of attention, of course, is the yield number. And I just want to put this in kind of context for what we were expecting to see as the information was released. So I went back and I looked at what was the pre-report industry estimates. What was the industry expecting to see out of this report versus what we actually got? So a relatively tight range, anywhere from about just under 171 to about 175. The 172.5 was actually the industry average, and that's really where USDA came out. Just as a comment, Brett, I do agree. I think some of the reduction that we saw, not only in the USDA numbers, but some of the concerns I have locally here, will be for the lighter test weights. Because of the late planting here in the northern plains, but because of some of the drought that's going on, especially in Nebraska and even parts of western Iowa. We may have cob, but and a lot of seeds. They may have pollinated, but the question is, will they have the kernel weight we need to get the yields? Well, how does the current yield forecast, which is the dotted line on the far right-hand side in red, how does that compare to the trend line? So the red line that bounces around, again, is the actual reported average yield for the United States. The blue line running through the middle is a trend line. So think of that blue line as kind of the average. Okay, it's an average crop that's been adjusted for technology, the better planting progress, the better machinery we have, the better management tools we have, as well as better genetics. So when we look at the blue line versus the red line, especially as the dots on the far right-hand side, you'll notice that, yeah, it looks like we're going to have a slightly below average yield nationally, but, it's not a disaster. Look at 2012. Obviously, that was, earth-shattering. We're not going to be looking at those kinds of conditions. So I wanted first to focus on the green line and the red line on top. The green line is total U.S. production of corn when we count bushels, which is scaled on the left-hand side. The red line is the total consumption, all possible consumption. So if we start looking at the differences between the production and consumption each year, that really helps us explain what happens to the blue lines on bottom. So the blue bars on the bottom are the stocks to use ratio. So we're taking our ending stocks, how much grain are we going to have from last year to carry forward into the next marketing year, divided by our total usage or total consumption. So think about it as what percentage of a margin for error do we have in case there's a problem. And what happens is the tendency is when that stocks to use ratio is very tight, when we don't have a lot of reserves, we tend to have higher average prices with a lot of price volatility, which is kind of what we're seeing right now. So if you look at the red bar, which is the current USDA forecast, relative to history, we're getting towards the bottom end of that range, which again suggests we're going to have higher prices with a lot of market volatility. And again, that is what we're seeing, and I'll make, in my concluding remarks, make some more observations about that. So we talked just a bit about the production. I want to look at the consumption, just again to put this in perspective. So as we start moving into what's happening globally, I also want to think about what is that going to do to our reserves here in the United States. So the blue bar on top is the estimate for feed and residual, basically the amount of corn going into the livestock sector. The red line is for ethanol. The black line is for exports, and the green line is kind of everything else. Once again, those little dots on the far right-hand side is the current USDA forecast. So domestic use tends to be the highest consumption rate for corn. However, when we look at the exports, even though it's relatively small compared to domestic use, it still can have a huge impact on pricing, mainly because it's so hard to forecast or predict what the export market's going to do. In the livestock sector, we don't see big shifts from month to month or even quarter to quarter on the amount of corn that we're using going into the livestock sector. On the ethanol perspective, we get weekly updates coming in from the Department of Energy to give us an idea of how much ethanol is being produced every week, so we can kind of back calculate and say, well, this is approximately how rapidly we're using up corn into the ethanol sector. Again, even though it's relatively small, that export number is a very, very difficult number to forecast, so it has probably an unusually high amount of influence on pricing. Just want to touch on ethanol production. Yes, we had some major disruptions during COVID. You can see the rapid drop that we had in the blue line. This is weekly ethanol production numbers. But it looks as though over the last 12 months or so, we're starting to get back into more of a normal cycle of production and usage for ethanol. Again, a lot of that's tied to energy prices. As gasoline prices go higher, we don't drive as much, which means we don't need as much ethanol. But that cycle, kind of that seasonal pattern that we're seeing is kind of returning. Profit margins in the ethanol sector are relatively strong. So let's shift into the global markets. So let's look at who do we compete against in the global markets. So the green line on top is U.S. corn exports. And you can see every year we've had quite a bit of volatility. Again, the dotted lines on the far right-hand side are the current forecasts coming out of USDA. Let's compare that to our major competitors. Who else do we have to compete to in the world market for corn and corn marketing? So the blue line is Brazil, the black line is Argentina, and the gold line is Ukraine. Now, I'm not going to spend a lot of time tonight talking about the war in Russia and Ukraine. I'll touch on a couple comments. If you have some questions, please, again, be sure to write those down and make sure you send them in. The point I'm trying to make is, yes, we have a drop-off, a pretty significant drop-off in the forecast for exports of corn coming out of Ukraine, which was a major corn supplier, especially into countries like the Middle East, into Africa, North Africa in particular, and even some into Asia. But our major competitors are really Argentina and Brazil. And if you'll notice, at least based on the current USDA forecast, again, anticipating some pretty good production coming out of both Brazil and Argentina next year, the forecast for their exports and their ability to compete with us are up. So the real question now is, are we going to be able to surpass what USDA is forecasting or not? I did several graphics here now of what is currently going on in the global market. So I tried to put, I know this is a little bit busy, there's a lot of information here, but I just want to point out a couple things. So every one of those lines represents the FOB, free on board, price for corn loaded onto a vessel. So I looked at several ports, exporting countries around the world, and I said, well, what's the average price for corn loaded onto an ocean-going vessel? So how do our port prices compare to our competitors? Now, if you're buying it, you still have to add on the ocean freight, which I'll talk about in just a minute. So the blue line on top, that bright blue line on top, is the U.S. P&W, relative to the green line, which is U.S. Gulf, the black line, which is Argentina, the red line, which is Brazil, and then the brown line on the very bottom is Ukraine. So I just want to point out, when you notice that big drop-off in Ukrainian prices, that essentially happened when Russia invaded. And they went down to a point because, the prices were so low, they really weren't shipping anything to start with. Notice that there was a quick rebound. That rebound was really because of the agreement that was made between Russia, Ukraine, Turkey, and the United Nations to allow continued exports, but not only corn, but also wheat coming out of the Ukraine and being able to start resupplying the globe. Their prices are lower, and I'll show you why in just a moment. Now, if you look back historically, yes, the P&W price and the U.S. Gulf price tend to be higher than some of our competitors, but again, depending upon where we deliver, who do we sell to, ocean freight can make a pretty significant difference. So ignore the column on the far right-hand side. I was trying to update all this information in the last couple of days. Some of the export data from USDA has been disrupted. The weekly reports on export sales, because of some computer issues, they're switching over to a new system. I really just want you to notice the countries. They're ranked from largest to smallest, basically the top 6, based on the information we had from 2020-21 marketing year. So not the one we've just finished, but the one before. The big buyers of U.S. corn over the last couple of years have been China, Mexico, Japan, Colombia, South Korea, and Taiwan. So of those countries, a large portion of them, China, Japan, Korea, Taiwan, are Asian countries. So we're talking about shipping from the US into those Asian ports. Mexico is a little bit different. We end up railing or using the rail system to transport a lot of the corn from the US into Mexico. So my point being is the freight rates, ocean freight from these different ports going into the Asian markets have a big influence over how competitive our prices are here in the US relative to, say, these countries buying from a Brazil or an Argentina or even a Ukraine. Let's look at ocean freight. So what has happened in ocean freight? I get this once in a while. Are they really high? Are they really low? Over the last several months, we've seen ocean freight rates starting to drop off again. And again, part of that is because volumes are starting to drop off and supply chains are getting to be a little bit more fluid. Most of the shipping rate problems we've had are in containers, not necessarily the bulk freight. So these would be the freight rates going from a particular port to North Asia. So North Asia is kind of an average of several different delivery locations, which include Japan, Korea, as well as China. So let's just, again, look at the relative prices. How expensive is it to get product from the US as well as US ports, but also some of the South American ports. So the red line on the bottom is the US P&W. So one of the reasons that the P&W bids for corn are a little higher is because the freight rates are also a little lower. Okay, so we have a freight advantage going into North Asia. So even though our shipping rates, the prices at port are higher than it is in Brazil or Argentina, we have some advantage over the shipping part of it. I also want to just highlight the black line. Notice that black line, that is from the Black Sea, which would include both Ukraine and Russia, into North Asia. If you look back historically, that was relatively competitive with the P&W, with, let's say, going from Argentina or Brazil. A lot of the difference you see in prices here is just the distance that's traveled. But notice what happened the last several months. When Ukraine was invaded by Russia, we saw a drop-off in rates because nobody wanted to go in there. Suddenly, as we got that trade agreement where there was vessels were allowed to enter and exit port, the prices have really spiked. And now it's not that the cost of running the vessel has changed at all, it's the insurance rates to get vessels into and out of those ports. So obviously, if I'm an owner of a vessel or I'm the captain of an ocean vessel, I don't necessarily want to spend a lot of time in the Black Sea going back and forth, not knowing exactly where all the mines and what the military actions might be. So there are people willing to do it, but they're going to be paid a significant premium in order to do that. So because of the higher shipping rates, the Black Sea really now is not a major market for corn, at least in the short term. Just to refresh everybody's memory, this shows soybeans ocean shipping, but the shipping routes that we use for corn are identical. You notice the two red ones coming out of the United States is out of the Gulf of Mexico as well as the P&W. Even though there's a route that shows we go through the Panama Canal, there's very few bulk vessels that go through the Panama Canal. It's just too expensive to go through the canal and pay the fees. The vast majority of the corn and soybeans and wheat hitting the Asian markets go around the southern tip of Africa, across the Indian Ocean, through the straits and back up into that North Asian marketplace. So when you think about the mileage or the distance that a vessel has to travel from the P&W versus the distance from the U.S. Gulf, it's rule of thumb, it's about double. Okay, so that's one of the reasons, again, the freight rates are higher coming out of the Gulf than they are coming out of P&W. Also, just point out the green line and the blue line representing Brazil and Argentina. Again, most of those ocean vessels are circumventing around the southern tip of Africa rather than going the other direction through the Panama Canal. So I pulled these as of this evening. They're actually from reports from yesterday, because of the timing differential and reporting. This is what's called the forward curve. So this is the price. If I'm a buyer in North Asia, what would I have to pay to get grain purchased and delivered to my port from these different origins? So if I'm buying from Ukraine, it's the brown line. If I'm buying from Brazil, it's the red line. If I'm buying from the U.S. Gulf, it's the green. Buying from the U.S. P&W, it's the blue. So what would I have to pay to buy corn and have it delivered to my port if I'm living in North Asia. I want you to, this is the forward curve. This is like the elevator putting out bids for delivery into the future. So if you look at that April or May time period and you say, well, now as a buyer, I want the lowest price possible. So right now for the next couple of months, it looks like US P&W has an advantage going into North Asia relative to, say, Brazil, even though the Safrina, or second crop Brazilian crop, is now exportable. Okay, we do have a freight advantage, mainly in freight through the U.S. versus the U.S. Gulf. But look what happens as we get into that June, April. Oops, excuse me. That is the wrong months. I apologize. It should start with October. I didn't update my slides. I apologize sincerely. It should be October, November, December. So by the time we get into December, which is that third month on the bottom, it's mislabeled, my fault. By the time we get into December, all of a sudden we're not as competitive as it is coming out of Brazil. Why is that? Because the first crop Brazilian corn crop is going to hit the marketplace. As we move forward in time, so again, start with, it would be October, November, December, all the way into midsummer, the Ukrainian crop is going to be higher priced. They're going to have a problem mainly because of the shipping rates. So I want to emphasize when we talk about weather and we talk about production possibilities coming out of Brazil, for corn we have two crops. The first crop, corn, is the same planting and harvesting progress as the Brazilian soybean harvest. So they're just beginning their soybean plantings. They'll be starting their corn plantings very, very soon. So that's the map on the left. Notice the core production regions are in the southern part of Brazil. The second crop corn, called the Safrina crop, is in the northern part. So that was the crop that just ended up being finished harvesting. As they finish harvesting their corn, they're going to come back and replant the soybeans. So that's more in the northern part of Brazil. So when we're talking about weather and impact of potential drought or potential rain showers on the corn crop, we're really looking at that southern Brazil portion. Argentina, just again, graphically, I want to show you there's a real concentrated region in Argentina where you have producing corn and soybeans. So the corn region and the soybean region are basically on top of each other. And I just want you to notice where Uruguay is and then that little bump of Buenos Aires. So recognize those because I'm going to show you some additional maps just for reference point on what's going on with weather and in particular soil moisture conditions. Now, this is some information. This is generated by satellite imagery. This is from satellites that both NASA uses to be able to give to USDA. They do their forecasts or estimates of what the soil moisture is. So it isn't really like the drought monitor map because it doesn't go as deep in the soil, but it does include the root zone. So we're looking at kind of the top meter, about 3 feet of soil. The two areas I want to highlight right now with corn is notice what's going on in southern Brazil. Their soil moisture conditions are actually in pretty good shape right now. Northern Brazil, not so much. They've got some issues starting to show up, but southern Brazil, very, very good soil moisture conditions. As long as we get good planting progress, it looks like that first crop corn out of Brazil has some potential. Now shifting over into Argentina. So look down towards that little bump where, remember what I pointed out, Uruguay, and then that little bubble that we used to be let me go back one, that Buenos Aires little bump on the side. So if you look at the core producing region for both corn and soybeans in Argentina, there's some real issues. And we had some problems not only with last year's crop, but that really hasn't improved at all. And there's some concerns about the Paraná River, which the Argentines use to be able to ship a lot of their soybean meal and soybean oil as well as whole soy. That river is running at very, very low levels, so they're having some transportation issues coming out of Argentina. Shifting to soybeans, so we're going to kind of follow the same path. It'll go a little bit faster now. On the production side, again, a slight reduction in both planted and harvested acreage. The big surprise coming out of Monday's report was obviously the soybean number. Nobody really expected that large a drop in estimates for soybean yields. But you look at what the range was for the private estimates, and the number that USDA came out with was actually below the lowest industry estimate. Again, thus the reason for some of the shock value. Again, I agree with some of Brett's comments. I do think, in particular in those drought areas, the concern is, yeah, we may have pods, but are those pods going to actually fill? Are there going to be seeds in them? are the seeds going to actually fill to the full test weight? We'll have to wait to see. I think there's some concerns showing up, in particular in the Western Corn Belt. When we look at are we looking at an average yield or an above average yield? What are we looking for on soybeans? The number we're getting right now is essentially a trend line yield. We had some pretty high expectations going on, but we've now backed it down to say, well, it looks like we'll have an average yield. This is not anywhere near a crop disaster. So I think we will have some pretty good supplies of soybeans. However, the consumption of beans is also pretty remarkable, to be very honest with you. So again, the green line being total bushels produced, the red line being total bushels consumed. Obviously, it's very easy to see when we had the trade war between the United States and China, we built up these big reserves because we couldn't sell anything internationally. We have been able to bring those inventories down, and again, we're on the low side of normal right now. People are getting a little bit nervous. Are we going to be able to manage our inventories? How high a price are we going to need to be able to make sure that we have some inventory left from this marketing year going into next? How do we use up soybeans? Blue line on top is crushing. We crush it into oil and meal. I'll make one quick comment about that, and then we'll move into the export portion of it. One of the changes that did happen now this last report, as we brought our soybean production down, we also had to start rationing our usage. We're not going to be able to sell as much, and there was more taken out of the forecast for exports than there was for domestic crushing. So when we look at the reductions, the export market took a little bit bigger hit in the numbers than the domestic crush did. So again, the dotted lines on the far right-hand side are the current USDA forecasts. Comment really quick about crush. So right now, there are 14 plants, crushing plants, either under construction, under expansion, or under development, meaning that there are companies that are planning to do it, but they haven't really broken ground yet. They've announced that they're going to do something, but they haven't broken ground. Obviously, those that are going through expansion will be completed. We've had several announcements of new constructions, in particular here in the northern growing regions. Obviously something that we get a lot of questions about on basis levels and what does that all mean for production here in the region. In a higher level sense, what I want to point out is, given USDA's forecast, let me go back one slide, they're forecasting essentially record crushing demand this year at that 2.2 million bushel, or billion bushels, excuse me. I don't think all of these plants will get expanded or will get built, but if they were to be built and the expansions were to be completed, that would add about 450 million bushels of demand. That's significant. Big question is, so where are all those bushels going to come from? Part of what I'm going to argue is we're going to have to steal them away from the international market. We're not going to be able to grow production fast enough to compensate for all of the new crush capacity, which means our exports may be dropping more, and we're going to keep more of that processing and usage here at home. Again, open-ended questions, we'll have to wait to see. What's happening globally with bids, with prices? Again, this would be the value of the soybeans loaded onto a vessel in a port ready to leave. Notice also, again, blue line PNW, green line US Gulf, black line is Argentina, red line is Brazil. These all tend to follow each other up and down. So even though on average the PNW soybean prices are higher than other loading points, some of that is offset by the lower transportation costs. Okay, so when we look at where's the product going to flow, in particular into the Chinese market, we're going to have to be watching this pretty closely. Not a surprise to anybody, China is our #1 customer. Again, please ignore the column on the far right-hand side. They have not been updated. But China, Mexico, and the European Union are major consumers of whole soybeans. So they buy whole soy from the United States and crush it in their own industries. Let's look at forward bids. Again, if I'm a buyer in China, I'm a buyer in Korea, I'm a buyer in the Philippines, what am I looking at? Where can I source soybeans really cheaply? And again, I apologize. I should have changed the months on the bottom. It should start with October, November, December. Okay. Unfortunately, we only have a couple months worth of information coming out of the PNW, which is the blue line. The green line, of course, is the US Gulf. What's really interesting to me is right now, with the current bids, the U.S. Gulf still has delivered or landed price going into North Asia the best market. I don't really put a lot of stock on the Argentine number because Argentina doesn't export a lot of whole soy. Most of the soybeans they export are processed into oil and meal. Their volume of exports for whole soybeans is actually very, very small. So right now those prices and things can change very quickly, but right now it looks like U.S. destination going into North Asia is still the preferred source. Obviously, we're getting into planting season in Brazil. Weather is going to be, and weather forecasts and what's happening with the crop development is going to be huge. Just want to remind everybody where Brazil produces soybeans. The darker the green, the more tons or bushels are produced. Again, northern part of Mato Grosso is the dominant growing region. We have a question.
Can we take a minute question?
Certainly.
With increased crush demand, could we end up importing more soybeans?
I really don't think so. Again, if I were to go back, so to directly answer that question, I want to go back to this graphic. There's about, rule of thumb is about 45–50% of the soybeans we produce stays domestic in the crush industry. About 40 to 45%, sometimes closer to 50%, are exported. So the odds are that we're not going to import soybeans from some other place. The odds are very high that we're going to just use more of it domestically and not have as much available to export. Okay, let's go to Argentina. Again, the production region for corn and soybeans are basically on top of each other. Just so think Iowa, Illinois, where they produce their corn is also where they produce their soybeans. I want to remind everybody, same graphic as what you saw before. Northern Brazil in that Mato Grosso, Goiás area, which is the big expansion of acreage, is a little bit on the dry side, but again, their soils don't have the water holding capacity that we do here, especially in the Red River Valley or in eastern North Dakota. So they do need rains on a more regular basis. They will have a drier conditions for planting, which typically lends itself for early planting as well as relatively rapid planting. So if you can get in the ground early, if you can get it planted really quickly, it has some higher yield potential. So we are looking at that and watching that very closely. I just want to again emphasize, so the big exporters of soybeans, the blue line on top is Brazil, the green line is Argentina, or green line is Brazil, excuse me, black line is Argentina. Brazil is the largest soybean exporter as whole soybeans. I'm going to add one more line. That's the imports by China. So the red line is how much does China import? The blue line is how much does Brazil export. Now, not all of the beans out of Brazil go directly to China. There are other countries that buy soy from not only the U.S., but also from Brazil. The point I'm looking at, the point of this graphic is, let's look at the green line and what USDA is forecasting for our export level relative to what they're forecasting coming out of Brazil, and more importantly, the usage levels that are demanded by China. Right now, the market is expecting a very, very large crop of soybeans coming out of Brazil. The expectation is they're going to expand their acreage base. Even if you plug in an average or a trend line yield, they're going to have a lot of beans coming out of Brazil. So translation is, in my opinion, the export window for U.S. soybeans is going to be relatively tight. Once those beans start getting harvested in Mato Grosso, come probably January or mid-February, then we're going to start to see a lot more price pressure in U.S. soybeans because we're going to start losing that export market. Shifting to wheat, again, I just want to talk about the yields a little bit just to be consistent. Again, the blue line is the trend line. The U.S. wheat yield, when you look at all classes of wheat, is down a bit. Most of that, again, this year is because of the winter wheat crop wasn't quite as large as we expected. I think most farmers that I have talked to have been either relatively pleased, or at least they got the yields, kind of average yields that they were expecting. I haven't really heard any major washouts or disasters on the yield side. Quality is a little bit variable this year, depending upon when you planted it and what kind of land it was planted on. But we are going to have reasonable supplies from the input side. So again, one more time, the green line is total U.S. production. The red line is total U.S. consumption. The reason the consumption is above production for wheat, partially we're starting to bring our inventories down. We're starting to use some of our inventory to be able to supply that usage, but we also have a little bit higher level of wheat imports in the U.S. relative to corn and soybeans. So if we look at all wheat, all classes of wheat blended together, we are finally bringing those wheat inventories down to a point where the market's starting to respond to tighter stocks. When we look at, again, this is all wheat blended together. I'll talk about spring wheat in just a moment. Blue line running through the middle is domestic milling. USDA calls it food, but it's basically domestic milling, the amount of wheat we use in the wheat mills here in the United States. Relatively stable, pretty easy to predict. The red line that bounces around, of course, is exports. In the wheat market, exports dominate pricing. Think about it this way, that the U.S. milling industry, basically all they have to do is bid the price just high enough not to get on a train or on a vessel to leave. And that's what they're going to do. Okay, so for wheat, this export market is critical for pricing. Who exports wheat? Now, there's a lot of different countries that export wheat. I only highlighted 3 of them. You can see some of the others kind of in the background shaded. I wanted to highlight the 3. The red line is Russia, black line is United States, the blue line is Ukraine. So yes, Ukrainian exports are dropping off significantly. They had an okay year. They didn't get all of their acres harvested, but again, their big problem is going to be shipping the product out. Russia, on the other hand, had a massive crop. They had a very large, especially winter wheat crop. They have been able to ship their product, but it's coming at a cost. As noted earlier, we've got some higher shipping costs, so the freight rates coming out of that Black Sea region are preventing some countries from buying large volumes out of that Russian market. When we look at prices, again, these are global prices. This would be wheat loaded onto a vessel. Now, this is winter wheat specifically. I want to be very careful. This is hard red winter wheat specifically. Okay, we don't have this kind of data for spring wheat, unfortunately. So the brown line, the one on the very bottom, that's Ukraine. Again, notice you can see the drop-off in prices because of the war, the recovery because of the agreement for shipping, and now we've seen a gentle lowering of prices, again, partially to compensate for those additional freight rates. But let's look at the other ones. Let's look at the green line, which is US PNW. How does the green line compare to some of our other competing countries? How does it compete against Argentina, which just finished their harvest? How does it compete against Australia? Their harvest is complete now. How does it compare against France and Germany? The Europeans had a reasonably good wheat crop, and in particular the French have been backfilling a lot of the sales that normally would come out of that Black Sea region in the form of Russia or Ukraine. Okay? So we have to be a little careful in the U.S. that our wheat prices don't get out of competition with some of the other competing countries. Who do we sell to? A surprise to a lot of people is that Mexico is our #1 wheat buyer and has been for several years. A couple years ago, China was a big buyer. Now they backed away pretty significantly. Usually the Philippines is a very close #2. Mexico and the Philippines kind of jump back and forth. Then we have Japan, South Korea, Nigeria, Taiwan, Indonesia. With the exception of 2 countries, they are all Asian countries. So U.S. wheat, whether it be winter wheat or spring wheat or white wheat, tends to go into those Asian markets. Mexico is a big buyer of U.S. winter wheat. They're becoming a bigger buyer of U.S. spring wheat. Japan, usually people think about wheat buying in Japan. Philippines, that I'll show you in a bit, is a very, very dominant spring wheat buyer. So coming back to winter wheat only, and the reason I'm going with winter wheat because we have the data, but also there's only so much of a premium that spring wheat can have over winter wheat. So what happens in the winter wheat market tends to dominate and have a huge influence on what goes on in spring wheat. This has been kind of our challenge. And I've done this kind of graphic. Again, there's October, November, December. I did fix this one. This has been one of the problems that we've had for a while. The U.S. winter wheat even landed, delivered to, when you include all the differentials for ocean freight, is still a bit overpriced relative to some of our competitors. So why is it that those countries, like a Japan, like a Philippines, like an Indonesia, are buying from the United States? It's a really great question. Part of it is quality, part of it is consistency, part of it is they want to build some stronger relations with the United States. You know, we are a reliable supplier. We're a little higher priced, but we are a reliable supplier. If you lean too hard on wheat coming out of Ukraine or Russia, like a lot of other countries, especially in the Middle East or in North Africa or Egypt, you know, they're starting to run into some serious problems on the ability to be able to access the grain and wheat that they want. Turning to spring wheat specifically, again, because of the drought we had last year, and our yields are okay, our acreage was about what we had before, we're really not rebuilding those inventories. We were able to take them down because of the drought. We're not really rebuilding them. The supply and demand seems to be balanced relatively straightforward. How do we use up spring wheat? Again, blue line is domestic milling, red line is exports. Very similar to kind of that all wheat number, but this is spring wheat specifically. So again, exports being very dominant. Who do we sell spring wheat to? By far, our number one customer is the Philippines. By far. Number two, very dominant, very consistent, very reliable market for us is Japan. Taiwan, pretty good. And again, I bring up Taiwan because of that now the relationship that we got between Taiwan and China and some of the political tensions going on. Surprisingly, Mexico is starting to grow in their interest and consumption of spring wheat. So that is something longer term I think we need to watch. I'm just about done, a couple more minutes here. These are as of the close today. So this is a long-term, what they call a long-term continuation chart. So the little, on the far right-hand side, the number in blue at 662, that's the close today. So all we're doing is looking at the nearby futures, and I'm going back into 1990. Now this has not been adjusted for inflation or anything, this is just the absolute prices. The reason I want to throw this up is, in the spring wheat market in particular, I think we got kind of spoiled, and our reference point on what's a good price versus not a good price got distorted. So I want to put this into like a long-term historical perspective for us. So this is for corn. I want to be very careful. This is for corn. Where are we today relative to where we were in 2011, 2012, 2013? Now I drew in the red line and those black lines and the green line on top. Those are numbers, those are support and resistance levels that I drew in. So realistically, we're kind of right in the middle of the range of prices that we saw back the last time we had really tight corn supplies. Okay, corn. We have had a nice recovery and rally in corn. Again, I've drew the blue lines in. Those are things, support and resistance lines I did just for reference. So where are we today for December corn as we move forward? What is the expectations? We are in an uptrend. It's kind of a longer term uptrend. You don't want to get too trapped into day-to-day price volatility. But we are in this uptrend. What's driving that uptrend? Combination of tighter supplies and some very strong demand. The demand side, even though we have had higher prices, really has not backed off that much. So the end users, the consumers of this, are looking at it and saying, well, it's expensive, they're complaining about it, but they're still buying corn. Shifting to soybeans. Again, I want you to focus on that on the far right-hand side, that 1455, which is the close today. That would be for November beans. Let's look at where we are today versus where we have been long-term history. As both Brett and Rob said, you know, these are not historic highs, but they are good prices. I know everybody wants a little more. They always want 10 cents more than we got, but let's put this again in historical perspective. Shorter term, let's look at what's happening. We've got a lot more volatility in soybeans. I think that volatility will continue until we get the combines finished and we have a better count on how many bushels we actually have. But as I want to emphasize, our marketing window for soybeans is getting shorter and shorter. As soon as that Brazilian crop starts coming off, as long as they have a good yield, we're going to be priced out of the marketplace. So we have an opportunity here, but Again, you've got to be very strategic in the timing of it. Wheat, again, I mentioned the wheat earlier. Now, we can ignore what happened in February of 2008. What I always tell people is, eventually, at some time in the future, we will likely see $20 futures again. However, the conditions that led to that price spike will never happen again. There was a very specific and unique set of conditions that led to that February of 2008 event. It's not going to happen again. So we can ignore that. My opinion, you ignore it. That means we fall back to the prices we saw this last spring are the highest we've seen on record. You take that out of the equation, that's the highest we've seen. So again, let's make sure we keep our reference points correct. I do understand and agree we've had a significant pullback and retracement in wheat prices. For spring wheat, we've now, pretty obvious we're in a trading range. My opinion, for whatever that's worth, I think we're going to maintain that trading range until we get a much better idea of what's happening in the corn crop. At this point, corn is going to be in the driver's seat. Wheat is going to be watching very, very closely and going to try and be competitive. So with that, are there any questions? Okay, so there's one in the back here.
Your last, I believe, Ukraine planting, winter wheat planting is now.
Yep, they're starting their winter wheat seedings, yes.
Any indication on if it's being planted and how that will affect?
I'm gonna see. I think I kept the chart in. No, I didn't. I'm sorry. I didn't keep the chart in here. Right now, the current industry estimate is about 30% of the winter wheat acreage will likely not get planted, either because it's occupied by Russian troops, or it is unable to be planted. Okay, now so there's seeding starting right now. Their winter wheat seeding is very similar to what we see again in Kansas or Oklahoma. But the current estimates, the ones that I have seen, both out of USDA as well as some of the private estimates, are about a 30% cut in planted acreage.
Follow-up question on beans.
Okay,
we have a very tight trading window. Is this rail situation potentially going to cause us to miss that window?
Okay, so the question is, because we have this kind of narrow window of export opportunity on soybeans, is this rail, potential rail strike and the rail disruption is going to cause problems? The answer is it depends, obviously. It depends upon how long does this last, how deep is it, or is it going to impact all of the major railways or just some of them? My personal opinion, again, for whatever that's worth, my personal opinion is I don't think this is going to last very long. A couple days at most. There's just way too much political pressure as well as economic pressure for both the railroads and the unions to get together and get this fixed. So my expectation is right now, yes, we need to keep an eye on it, but I don't see this lasting more than a couple days at most. So it'll take us a while to kind of work through the backlog, but after that I think we'll be okay. Question from online?
Yep. Is there a historical perspective on what could happen to basis and price?
So there are two reference points we could probably use. One is what happened in 2013-14 when we had the rail disruptions because coming out of that drought year. If everybody remembers 2013, winter of 2013 and 14, we had some real issues with rail. And it was not just here in the Northern Plains, it was more system-wide. And so we did see basis levels crash pretty hard. The other reference point would obviously be from the US-China trade war. I do think that was more aggressive just because of the size and the volume of product that we're talking about. So probably a better reference point is what we had as a proxy or kind of an indicator would be what happened in 2013-14. But like I don't remember the exact numbers, but we were looking at some pretty big basis levels. I think $1.40, $1.50 on soybeans. I think we were close to $1 or a little over on corn, and probably $1 or a little over on wheat. So very dramatic drop relative to what we see today. No more questions. Well, again, thank you for your time. Thank you for the opportunity to visit. I'll hand it back over to our host.